everyone. Am I audible, sir?
Yes.
So I'll be discussing some important amendments and introductions which has been done through this Finance Bill 2022. Before that, after the discussion of Kuti sir and Sobhan sir, I would like to call this budget as not just an election budget, but also a smart and digital India budget, which is also an Atmanirbhar Bharat budget and a Make in India budget. So with this, I would like to start. So let's have a look into certain newly inserted sections. Firstly, the new updated ITR under section 140B. This income tax return is in addition to the regular income tax returns which are already in existence. This has been introduced with effect from financial year 22-23, and this return needs to be filed within 2 years from the end of relevant assessment year under separate section 139(8)(a). This return can be filed even if the assessee has filed the original return or not. This is basically introduced so as to make the taxpayer voluntarily compliant and disclose all his undisclosed income by paying an element called additional tax. So this additional tax is levied at the rate of 25% if the return is filed within 12 months from the end of the relevant assessment year. And if the return is filed after 12 months from the end of the relevant assessment year, the additional tax would go up to 50%. This return cannot be filed if any search, seizure, or any other notice is issued to the assessee regarding that particular assessment year. Also, this return cannot be filed if filing this return of income makes the income tax less or refund is increased, or if it is a loss return, this return cannot be filed. Also, this additional tax is not calculated on income, but it is calculated on the tax and interest which has been filed in the original return. This additional tax is again increased with the cess and surcharge. Next is a virtual digital asset. This has been a topic of sensation from past 2 years, where lakhs together and crores together transactions are going on, and a lot of them don't even have any basic idea of it. So there was recently a case law after the RBI imposed a ban on cryptocurrencies and transactions, so as to regulate and keep the transactions and illegalities in order. So this ban of RBI was lifted by a case law, by a case put up by the Internet and Mobile Association of India, and because of which this virtual digital asset taxation scheme has been put up in this finance bill. Also, digital currency regularization has been brought into from this budget. More details regarding this has to be given out through notification and circulars, but introduction of this virtual digital asset is to control and regularize illegal transactions in the virtual world. So what is virtual digital asset? It is defined in section 2 of income tax as any information, code, number, token which is not currency, but these items like photos, videos, artworks, and properties which are existing only in the electronic world and not in physical world, to be purchased or dealt with the crypto currencies. These currencies are generated through the crypto mining and by performing certain algorithms. So these transactions, to get into control, a taxation has been introduced for these virtual digital assets. Taxation has been introduced right away of 30% on this, which is increased by cess and surcharges as applicable to the type of assessee. Also, this calculation of income is similar to the capital gains, where only cost of acquisition is allowed as deduction for calculation of income. No other expense in acquisition of such asset or related to transfer of such asset is allowed as deduction. Further, any loss from this sale or transfer of such digital assets they are not allowed to be carried forward for any further relevant assessment years. Also, they're not allowed to carry a set off against any other income of the assets. Also, gifting this virtual digital assets is treated as transfer of property and also taxed under section 56 as income from other sources. Also, there is a tedious imposition on these virtual digital assets where any person pays an amount exceeding 10,000 rupees for transacting with these virtual digital assets at the rate of 1% of such amount. But if such consideration is paid to specified person, the threshold limit will be 50,000 instead of 10,000. So these specified persons are those who do not have any business income, or though having business income are not liable under tax audit. This limit is done only to ease a little bit people who do not have or more monetary transactions. So this section overrides any other section related to TDS with regard to virtual digital assets. In case of conflict between 194O, which is related to e-commerce operator, this section prevails. Let's move on to certain clarifications given in this budget. Firstly, COVID tax relief scheme. Any amount received from the employer to the employee without any consideration is treated as perquisite. But if such amount is received by employee for the treatment of employee or any person of his family, it is not included as a perquisite. And any amount which is received by any person in excess of 50,000 without any consideration is treated as gift and taxable under income from other sources. But now, if any such amount is received with regard to COVID-related treatment from employer, is completely exempted and it is not treated as income. If the same is received from any person other than employer, that amount will be tax-free and not considered as income if it is received within 12 months from the death of such assessee, and if it is only up to rupees 10 lakhs per annum. Section 35. There has been a deduction if any assessee contributes to scientific research started by any research association, university, college, or any other institutions. These contributions were allowed as deduction to the donor. But now it will be deemed to be disallowed unless a statement of donations of such contribution received by such universities have been uploaded or filed with the income tax department by such institutions. 37.1. Other expenses. This section is given in this bill to make a small clarification regarding the prohibition of law. Here, there is a clause saying expenditure incurred, which is for the purpose of doing any earning any income or any expense which is prohibited by any law, that is not allowed as an expense for the business of the assessee. But the act was not clear as to this law is inclusive of law outside India. Now the same has been clarified as any law either inside or outside India. If any expense is prohibited under any such law, it is prohibited and it is not allowed as an expense. 43B, deduction only on actual payment basis. Here, certain expenses are allowed only on actual payment made in the financial year. So here one such item is interest outstanding on loans. This interest outstanding is not allowed as an expense only on mere conversion of the same into loan. This was the existing provision, but now there is an addition made which says such conversion of interest outstanding into a debenture is also not treated as payment, and it is allowed as an expense only on actual repayment of such interest. With regard to certain tax rates, there is the cooperative society which has been benefited with regards to tax slabs. So here, cooperative societies surcharge was 12% for complete income exceeding 1 crore. Now the same has been reduced to 7% for cooperative societies income exceeding 1 crore but up to 10 crore. Also, alternate minimum tax rate for the cooperative societies was 18.5%, Now the same has been brought down to 15% so as to keep it in par with the companies and also to help rural and farming sectors. For all other individuals and corporate sector, there is no change in tax rates and slabs. Some provisions relating to deductions. CCD to National Pension Scheme. Here, earlier, only central government employees contribution made by employers to the pension scheme was allowed as a deduction up to 14% of basic NDA. For state government, the same was only up to 10% of such contribution. Now, to treat the employees of state and central government at par, the same has been increased to 14% for state government employees as well. 80DD, deduction related to disabled person. Here, currently, this deduction was available if a person, assessee, or the person who subscribed to the scheme for maintenance of the disabled person is in the process of paying any annuity or lump sum to the LIC or such insurance related agencies, so as to get some amount for maintenance of such disabled person. This deduction was available only on death of such subscriber when the amount was realized. But now this finance bill has extended such benefit even if the assessee is alive and after and is attained age of 60 years or more. This benefit is still available to the assessee without getting taxed. Certain time limit related extensions. So now the incentives extended by an year. This is done for certain startups and manufacturing sectors which had given income-based deductions to encourage the setting up of such units. The commencement time limit given for these startups and manufacturing sectors was up to 31st March 2022 and 2023 respectively. And the same has been increased by a year so as to encourage the small units and also to encourage them to contribute to the country's GDP in a good way. Faceless schemes and other act. Due to the pandemic reason and not to withhold the ongoing proceedings or litigations under the act, certain schemes were introduced under faceless scheme in the previous finance bill. The limitation of time for such schemes was 31st March 2022, and now the same has been increased to 31st March 2024. So as to enable and give a correct amount of time for the panel as well as the assessee to gather evidences and proceed with the case. Thank you. I would like to pass on the discussion to my client Shruti, to my colleague Shruti.